This has been a head scratcher to a lot of people. Unexpected kind of turn of events, though Fitch had indicating this may be coming down the pipe. Fitch certainly catching investors off guard. Now, this despite the rating agency warning over the last few months it could make this kind of move. So let's talk about market reaction. Joining us now, Michael Arone, Street Global Advisors Chief Investment Strategist for the U.S. Spider business. Okay, Michael, so it did seem like a surprise yesterday when the announcement came out. What would you say was the most surprising piece of this? Was it the news itself?
I think what happened is in May, Fitch did put the U.S. on watch. Mm-hmm. So I think we need to take a step back in terms of the surprise element of this and recognize that they were evaluating. And to me, I think the biggest thing is around those governance standards. And I think what they're basically acknowledging is before the ink was even dry on the debt ceiling resolution, a small faction of Republicans were already questioning the deal and threatening to hold up some of the budget requirements for later this year. And you add in the additional spending from kind of the rescue plan, the American Rescue Plan, the Inflation Reduction Act, the infrastructure bill, combined kind of with lower tax receipts and higher interest costs. And I'm not all that surprised. I think the biggest thing is that the market hasn't really reacted all that much to this so far.
Why not?
Well, I think times are a little bit different in terms of we were coming out of the financial crisis. Years of excess had built up in terms of the mortgage crisis that had to be worked through. You mentioned Europe, Julie, for example, was also undergoing their own debt crisis. And I think it was just a much greater volatile time coming out of that kind of the aftermath of the global financial crisis. Today, I think the economy is growing. Earnings seem to be bottoming. The Fed perhaps is getting closer to the end of its tightening cycle. And so I think that there are just a number of conditions that are a bit better today than we were in 2011.
So we kind of had an offline conversation before the show started about like companies that this may impact. And, you know, we had a conversation like Apple, this wouldn't matter to them. Yeah. So what kind of companies does this matter to?
I think there could be an impact as you move downstream in credit quality. So below investment grade, junk bonds, loans, those types of things. If they're pricing off of 10-year Treasury yields and there's a pickup in 10-year Treasury yields to reflect kind of a less secure credit rating for the U.S., I think that's where you're going to have your biggest impact. Apple, stealth balance sheet, lots of cash on the balance sheet. They already have a better credit rating than the U.S. already. So I don't think it's going to kind of bother those bigger, top tier, high credit quality companies. I think maybe at the margins, as you move down in credit quality, you might see some impact. But I think spreads yesterday, in terms of junk bond spreads, were well behaved. The market really didn't react too much to the news.
And are there any implications for Treasury investors, for that matter, the debt itself that they downgraded?
So, Julie, I think that is one of the key things that was interesting, and you had shown some of the charts and the reaction. So last time, there was this flight to safety and yields fell, which is counterintuitive. This time, I think there's a few dynamics going on here with the Fed raising rates. Japan is now moving away from yield curve control. So they might be buying less treasuries and buying more domestic debt. So all of a sudden, you could see rates creep up here, which is different than last time. And I do think that'll have a broader impact on the markets because I think that'll hurt valuations. Now, we haven't seen it yet, but this is worth watching. So if 10-year Treasury yields creep up instead of down, that has impacts for risk assets.
Do you think this does anything to kind of how the dollar stands as the reserve currency, its status there, or is this a nothing burger?
So that's why I don't know, like, Larry Summers and some of the reaction. Boy, I wouldn't shrug this off. The reason that the U.S. has been able to kind of withstand so many economic challenges is the exorbitant privilege that we have as the U.S. dollar being the world's reserve currency. Kind of playing with fire with that. Boy, I think that's risky. Now, certainly that's not going to change overnight, but boy, I wouldn't kind of diminish the potential risk of basically challenging the US dollar as the world's reserve currency. And this whole idea on governance standards and the fighting and the debt ceiling, they're playing with fire. Now, again, I'm not Chicken Little here. The sky's not falling, but I do think that that is a risk to markets. It really is the key reason the U.S. has been able to withstand so many challenges over the years compared to other regions of the world, compared to other countries, and to challenge it or to put it at risk just seems silly, especially because I don't think it's necessary.